Have you ever wondered what happens to your money the moment you deposit it in the bank? Is it just sitting there waiting for you to withdraw it? Or is the bank doing something else with it? In today's video, we're diving deep into the mysterious world of banks and explaining exactly what they do with your hard-earned cash. Stick around because the truth is a lot more interesting and complicated than you might think. What do we think happens when we deposit money in a bank? When you deposit money in a bank, most people think that the bank just holds on to it safely for you. You give them your cash, and when you need it, you withdraw it. That's partly true, but there's a lot more going on behind the scenes. How banks work in a nutshell. Banks act as intermediaries between people who have money and people who need it. Banks take in deposits and, in turn, lend out a portion of that money to borrowers. Here's where things get interesting. Banks don't just hold on to your money, they lend it out to others. This is possible because of something called fractional reserve banking. Here's how it works. 1. Deposits are used as a base. When you deposit money, the bank is required by law to keep only a fraction of your deposit in reserve, often around 10%. This is known as the reserve requirement. 2. Lending out the rest. The rest of your deposit, 90%, is lent out to others, whether it's for home loans, car loans, business loans, or credit cards. 3. Interest. Banks charge borrowers interest on the loans they provide. They then pay you a much smaller interest rate on your deposit. The difference between the interest the bank earns and the interest it pays is how banks make a profit. Example: if you deposit $1,000 in a bank, the bank may lend out $900 of that to someone who needs a loan. The bank earns interest on the loan, but your $1,000 is still available for you to withdraw whenever you need it. This all sounds great, right? But here's the catch. The bank is taking a risk by lending out your money. After all, if too many people want to withdraw their money at once, the bank might not have enough cash on hand to give everyone what they want. This is called a bank run. And it's a risk that banks manage by keeping a certain amount of reserves and using other mechanisms to ensure stability. How banks manage risk. Reserve requirements. As mentioned, banks are required to keep a portion of deposits in reserve, so they always have money on hand for withdrawals. Diversification of loans. Banks don't lend all of their deposits to just one person or one business. They spread it across various loans to reduce risk. FDIC insurance. In the U.S., deposits up to $250,000 per depositor are insured by the U.S. Federal Deposit Insurance Corporation, FDIC. So even if the bank fails, your money is safe up to that amount. Let's break it down with a simple example of what happens when you deposit $1,000 into your checking account. The bank records it in your account as a liability. They owe you that money. Second, Step 2. The bank keeps a portion in reserve. The bank is required to keep a portion of that deposit in reserve, let's say 10%. So in this case, they must keep $100 as reserve, and the remaining $900 can be used for loans. Step 3. The bank lends your money out. The bank then lends out a portion of that $900 to a borrower who needs a loan. The borrower might be taking out a mortgage for a home or a personal loan. Step 4. The borrower pays interest. The borrower will pay back the bank over time with interest. That's how the bank makes money. Step 5. Your money is still available. Even though the bank lent out $900 of your deposit, your $1,000 is still available for you to withdraw when you need it. How? Because banks work with cash flow. They don't need all the deposit at once, and the loan repayments from other borrowers help maintain the balance. Now, what if you want to withdraw that $1,000? No problem. The bank will give you your money, and they can do this because they have the cash flow from the loans they've issued. They're managing their reserves, and if necessary, they can borrow from other banks or the central bank to ensure they have enough cash on hand. So, to sum it up, when you deposit your money in the bank doesn't just store it, it uses a portion of it to issue loans to others. The bank makes money by charging interest on loans, and you earn a small interest on your deposit. This system works because of our fractional reserve banking, where banks only need to keep a fraction of deposits in reserve and lend out the rest. Thanks to FDIC insurance and careful risk management, your money is safe even though the bank is lending out most of it. The next time you deposit money, you'll know exactly what's happening behind the scenes. It's not magic. It's a well-designed system that helps fuel the economy and allows individuals, businesses, and governments to access credit. If you have any questions about banking or want to dive deeper into another topic, drop a comment below. I love hearing from you. Thanks for watching, and I'll see you in the next video.